$1.3 trillion. Gone. Erased from the world's biggest technology companies in a single afternoon last week. And the company that set it off didn't even miss its numbers. It told the truth.
Friday. It's a sea of red. The high-flying chip stocks bleeding out. Then the AI crowd screams, "Buy the dip!" and the same names claw it right back. And then the rug gets pulled all over again.
And if you're sitting there refreshing your brokerage app, trying to time that whiplash, you're not investing. You're standing on a casino floor where the house resets the wheel every single spin.
From Trek for Wealth, this is the podcast where we skip the panic and find the boring next sentence. I'm Avery.
And I'm Grant. Today, the AI trade just flashed its first real warning, and an 1849 gold rush tells you exactly what to do about it.
Okay, Grant. $1 trillion in an afternoon. Chip stocks swinging like a fever chart. I'll admit it, I watched my own account do something I didn't love this weekend. But you keep saying don't panic. So what actually happened, and why are we about to talk about gold miners?
Because this exact thing has happened before. Twice, that matter. Once in a Silicon Valley boardroom in the year 2000, and once, the original, on a muddy street in San Francisco in 1849. Same rush, different shovels.
Let's get into it.
San Francisco, 1849. A shopkeeper named Samuel Brannan owns the only store between the city and the gold fields. He hears gold's been found up at Sutter's Mill, and before he breathes a word to anyone, he quietly buys up every pick, every shovel, and every pan in the city.
Everyone?
Every one he could get his hands on. Then he runs through the streets waving a glass jar of gold dust over his head, screaming, "Gold! Gold from the American River!" He didn't light the fuse so he could go mining. He lit it so the miners would have to buy their shovels from him.
That is gloriously cynical. Did it actually work?
$36,000 in the first 9 weeks. His store was pulling in $150,000 a month by 1849. He became the richest man in California, the state's first millionaire. And Avery, he never mined a single ounce of gold in his life.
So he cracked the code. The real money isn't in the gold, it's in the gear.
That's the whole game. On Wall Street, they still call it picks and shovels investing. When everyone's stampeding toward the same shiny thing, don't bet on which prospector strikes it rich. Sell them all the tools. The history of every gold rush is really the history of who sold the shovels.
And today's shovels are the chips.
The chips. The hardware every AI company has to buy. Nvidia, Broadcom, Micron. Nobody knows which AI app wins, but they all need the silicon. So for 2 years, the smart money piled into the shovel makers, and the shovel makers got to name their price.
But you said this happened before, in 2000. Same play?
Beat for beat. March 27, 2000. The hottest shovel maker on Earth is a company called Cisco Systems. They make the routers and switches, the literal plumbing of the internet. Every company racing online has to buy Cisco gear, and Cisco gets to set the price.
I actually remember Cisco being the stock.
On that one day, Cisco becomes the most valuable company in the entire world, bigger than Microsoft, worth around $550 billion. The stock hits $80.06 a share.
So if you'd bought that day, the safe pick, the shovel maker, the literal backbone of the whole internet,
you would have waited 25 years just to break even.
25 years?
It fell almost 90% over the next 2.5 years, and it didn't reclaim $80 a share until December of last year. 25 years and 8 months. And here's the part people miss. Cisco wasn't a fraud. It wasn't a fad. The internet was completely real. Cisco is still a giant, profitable company today.
So what actually went wrong for the people who bought it?
The price. At that 2000 peak, Cisco was trading north of 200 times its earnings. 200. There's an old rule from a Wharton professor. Once even a wonderful company gets priced above 50 or 60 times earnings, buyer beware. The business was great. The price was insane. And the price is the thing you actually buy.
They were right about the internet. They just paid too much to be right.
That's the entire episode in one sentence, Avery.
Okay, bring it to last week. What actually set off the trillion-dollar afternoon?
A company called Broadcom, one of the big AI chip players, reported earnings. And they were good. AI revenue up more than 200%. But Wall Street wanted spectacular, and management did something almost quaint. They told the plain truth. Solid growth, and they declined to raise next year's forecast.
They got punished for not exaggerating?
Punished for not promising more. The stock dropped double digits, and because traders sell the whole group first and ask questions later, it spread fast. Micron, a memory chip maker that had tripled this year and crossed $1 trillion in value, fell 8% one day, 13% the next. The chip index had its worst day since the early days of COVID. All in, about $1.3 trillion of market value gone in a session.
Over one company declining to raise a number.
Over a hint that maybe, just maybe, the AI build-out won't accelerate forever. That's all it takes when a stock is priced for perfection. Sound familiar?
Cisco, 200 times earnings.
And look at the sheer scale of what's being bet here. The hyperscalers, Amazon, Microsoft, Google, Meta, are on track to pour somewhere between $660 and $700 billion into AI infrastructure this year alone. That is roughly 2% of the entire U.S. economy, flowing into chips, cooling systems, and data warehouses.
And because everyone's building at the exact same time, the shovel makers can charge whatever they want.
That's the Chipflation piece. The raw memory that goes into these data centers has jumped from about $3.76 a gigabyte to $9.71 in under 2 years. The hardware guys are extracting all the wealth right up front.
So the giants are spending hundreds of billions to build the highway before anyone's proven there's a car that actually needs to drive on it.
That is the multi-trillion-dollar question. The spending is real. The revenue to justify it hasn't fully shown up. And the day a supplier so much as hints the cars are running late, the whole thing wobbles.
And then, on top of all that, the rate picture turned, didn't it?
Same morning as the crash, the May jobs report came in hot. Way more jobs than anyone expected. Good news for workers. But it pushed interest rates up and took a Fed rate cut off the table. And high rates make expensive, borrowed money growth stories worth less on paper. So the shovels got hit from both sides at once.
And meanwhile, away from the tickers, what's it actually like out on Main Street right now?
Funny you ask, because a small business survey landed this very morning. Optimism at its lowest since late 2024. The uncertainty reading running about a third higher than normal, and the chief economist nailed the split. All this excitement about AI investment at the top, while the owner of the shop down the street is just trying to absorb a fuel bill she can't pass on to her customers.
Think about that gap. Silicon Valley is tossing $700 billion at data centers, while the local contractor and the neighborhood logistics firm are pulling back hard, choked by 20% credit card rates, sticky labor costs, and an insurance bill that jumped double digits.
The top of the economy is running an AI space race. The rest is trying to figure out how to finance a work truck. And if your retirement account is overloaded on a handful of these tech names, your life savings are riding on a volatility machine with almost no connection to the economy you actually live in. Two speeds, and that gap is exactly where regular investors get hurt.
All right, let me play the optimist for a second. Isn't it different this time? AI is real. These companies actually make money. Cisco had a lot of fantasy revenue around it, but Nvidia's selling chips it can't make fast enough.
And you're right. That's the strongest argument, and it's a good one. This is not the year 2000 all over again. At its peak, Cisco traded around 200 times earnings. Today's leading AI chipmaker is closer to 45. Expensive, yes. Insane? No. The demand is real, the profits are real, and the boring truth is the internet eventually did change everything. It just took a lot longer than the stock prices promised.
So the bulls might genuinely be right.
They might, but the other side of the table says one word: concentration. A handful of companies now drive most of the market's gains, all leaning on the same AI story. And when one of them so much as clears its throat, like Broadcom did, they all fall together. That's not a fundamentals problem. That's a crowding problem.
So the honest answer is nobody knows.
The honest answer is nobody knows when, and nobody knows which name, which is the entire reason we don't bet the farm on the timing. We prepare. We don't predict.
Okay, this is the part everyone came for. I'm watching my tech stock swing 10% over a single weekend. What do I actually do? Give me the moves.
5 of them. Move 1. Separate the company from the stock. A great company and a great investment are two different questions. Before you buy any single name, look at what you're paying for each dollar of earnings. If a stock is priced for perfection, then perfection is the only thing keeping it up.
Move 2.
Run a concentration audit tonight. Open your 401k and your brokerage and actually add it up. A target date fund plus a large cap growth fund plus a couple of individual chip names, and you may discover that 30 or 40% of your entire net worth is riding on 3 or 4 boardrooms in Northern California. Real wealth is built through concentration. It's preserved through diversification. Put a hard cap on single stock tech.
Move 3.
Build what I'd call a volatility moat. Keep your speculative individual stock bets to low single digits of your total portfolio, the amount you could watch drop by half and still sleep at night. Then automate the core into low-cost index funds, so you're not making emotional trades on a Friday afternoon.
Move 4.
Rebalance. Don't react. If that 2-year run left tech as a giant slice of your portfolio, trim it back to your target weight on a schedule, not on a headline. That quietly banks some of the gains from the run-up. And park what you trim somewhere boring. Treasury bills or a money market paying around 4 to 4.5% while the dust settles. Cash isn't trash. Cash is liquidity, and liquidity is insurance when the regime shifts.
And move 5, the one that ties this whole thing together.
Move 5. Don't confuse a great technology with a great price. The internet was the real deal, and the people who bought the backbone of it at the top still lost money for a generation. Being right about AI is not the same thing as making money on AI. Time in the market and broad diversification beat trying to time the rush. Every single time.
So what happened to Sam Brannan, the Shovel King? He got out clean, right?
You'd think so. He made his fortune, never touched a speck of gold, and then he forgot his own lesson. He poured everything into wild speculation. land, ventures, borrowed money, overextended himself completely, and he died broke and forgotten in 1889. His body went unclaimed for a year.
The shovel salesman went bust.
The man who taught the world that the smart money sells the shovels couldn't resist swinging the pick himself. And that's the lesson that outlives all of this. The technology will be real. Some of these companies will be giants for decades. But the price you pay and the size of the bet you make, that's the part you actually control. A gold rush is exciting. A volatility moat is boring. And boring is what's still standing in 25 years. Preparing without predicting. Always.
That's Trek for Wealth. Keep trekking.